Happy Monday. 4-1 advancing the declining stocks, up 160 points, but still pretty modest given the fact that we've talked about, the president's talked about substantial progress in the trade talks, the tariff hike delay. A lot of this, as we keep saying, is already starting to get very much priced into the market. So we're back to where we were at the highs in December, the last highs. That was 2,800. Remember that? December 3rd it was, as I recall. So here we are right back. Full circle, 2,800 to 2,351. That was the bottom on the close on December 24th, all the way back to 2,800. And people keep asking me, why did we rally so much? Well, because there's a lot of stuff that we were worried about in December that kind of looks off of the table all of a sudden now. Let me run down the numbers. An aggressive Fed, they seem to be out of the rate hike business. How about a trade war? That looks kind of less likely. How about that big oil plunge we were all worried about? There's going to be signs of a global recession. That ain't happening anymore. And what about that global recession, which is the main story motivating the stock market? Seems a little less concerned. China a little more stable. Europe still definitely not good. We want to hear from Powell this week about that recent string of weak economic data in the United States. The Fed on Friday in its report partly blamed trade issues. So the question, Mr. Powell, this weak economic data in the U.S., if the trade war goes away, will that improve? That's the one question I would ask Jerome Powell this week. As for what we're doing today, it's the cyclical game and lower moves from more defensive sectors. So look, you've got semis, banks, industrials leading, consumer staples, a defensive group to the downside. The China stocks, of course, they're moving. I'll just put up some of the ones that trade right behind me here. JD.com, Alibaba, Baidu, and Sina, all up 3 or 4%, as you can see. The key story is that the global recovery has been a largely cyclical rally. So we're up 18% on the S&P since the December 24th low, but you see industrials, tech, energy, all outperforming the overall markets. And the laggards, of course, are those defensive names, your healthcare, consumer staples, and utility. I would note particularly healthcare, which was a big market leader last year, is now a market laggard. This is a global recovery. I have mentioned many times that not just China, but if you look at IFA, IFA is Europe, Australasia, Far East. That's essentially the world X the Americas. Also up about 10%, not quite as outperforming as the U.S., but emerging markets, even frontier markets like Nigeria, for example, have generally been up, although overall lagging the United States. One final comment. I think it's very significant that GE sold its biotech business to Danaher because they appear to be taking that big IPO, that GE Healthcare IPO, off the market now. This is very important because the way I have it, this probably, the GE Healthcare would have likely been the second largest IPO in the United States in 2019. Uber at $76 billion would be number one. These are total valuations, not what they would float for. But WeWork, some of the other ones out there, Palantir, Airbnb, Lyft, they're all much smaller than that GE number. The reason I bring it up is we're looking to go 600 billion or so this year in IPOs. A float would be 100 billion. That's a significant issuance off the IPO market, and I think would be helpful overall. There's a lot of stuff coming in. We have more than 200 IPOs priced this year. You take what might be the second largest one off the market, it helps all the other ones out there because the question is who's going to buy all of this stuff on the year, and GE taking one of its main ones off the market I think would be helpful for the IPO business. We're just near the highs for the day, Carl. 200 points on the Dow almost. Back to you.